Imagine a country that earns trillions of dollars every single year, a country with millions of workers, thousands of companies, and an economy powerful enough to influence global markets across the world. Now imagine that same country owing more money than it has ever borrowed in its entire history. At first glance, that situation sounds almost impossible, because if a nation generates such enormous wealth every year, it seems logical that it should be able to manage its finances without accumulating massive debt. Yet this is exactly the situation many countries face today. Some of the richest nations in the world carry the largest national debts in human history. The United States owes trillions of dollars, Japan owes even more relative to the size of its economy, and many European countries also operate with enormous debt levels. Across the world, governments continue borrowing money every year, issuing new debt and extending financial obligations further into the future. Instead of shrinking, global government debt continues to grow larger and larger. This raises an important and often confusing question. If governments collect taxes from millions of citizens and manage huge economies, why does the national debt almost never disappear? In fact, most of the time it grows. Political leaders frequently promise to reduce debt, balance budgets, or restore financial stability, yet decade after decade the numbers continue to rise. The explanation for this pattern is not as simple as irresponsible spending or financial mismanagement. The truth is much more complicated and deeply connected to the structure of the modern financial system. To understand why countries remain in debt, we must first understand how governments finance their economies and why borrowing became a permanent part of economic policy. For most of human history, governments did not operate with continuous borrowing the way they do today. In earlier centuries, national budgets were relatively small compared to modern economies. Governments mainly focused on defense, law enforcement, and maintaining basic infrastructure such as roads or ports. Large-scale public spending programs were rare, and borrowing money usually occurred only during emergencies. When a country faced war, famine, or reconstruction after conflict, leaders sometimes borrowed money temporarily to deal with the crisis. Once the emergency ended, the priority often became repaying that debt as quickly as possible. Debt was considered a burden that needed to be removed rather than a normal tool of economic policy. But during the 20th century, the role of governments began to change dramatically. Industrialization transformed national economies and expanded the scale of production, trade, and technological development. As societies became more complex, citizens expected governments to provide more services and support. Public education systems expanded, healthcare programs developed, transportation infrastructure grew larger, and governments began investing heavily in economic development. Funding these responsibilities required enormous amounts of money. Taxes provided a significant portion of government revenue, but they were rarely enough to support every new program or infrastructure project that modern societies demanded. This is where borrowing began to play a central role in government finance. Instead of waiting years to collect enough tax revenue to build a major highway, expand a rail network, or invest in energy infrastructure, governments could borrow money immediately and repay it gradually over time. The logic behind the system seemed reasonable. If borrowing allowed governments to invest in projects that increased economic productivity, the resulting growth would generate additional tax revenue in the future. That future revenue could then help repay the original debt. In theory, this approach allowed governments to build infrastructure and stimulate economic development much faster than relying on taxes alone. However, as borrowing became easier, it also became more common. Governments realized that issuing debt could help them manage economic cycles, stabilize financial markets during recessions, and respond quickly to unexpected crises. Over time, borrowing gradually shifted from a temporary solution into a permanent feature of modern economic management. Instead of eliminating debt entirely, governments began focusing on maintaining it at levels they believed were sustainable. As long as lenders continued to trust that governments would eventually repay their obligations, borrowing could continue indefinitely. This transformation changed the role of debt in modern economies. Debt was no longer simply a sign of financial distress. Instead, it became an integral part of how modern economic systems operate, shaping everything from government spending to financial markets across the globe. However, there's another layer to this story that most people never hear about. Many assume national debt simply exists because governments spend too much money, but the reality is far more complicated than that. In fact, the modern financial system quietly depends on government debt in order to function smoothly. When a government wants to borrow money today, it usually does not borrow directly from another country or from a single large bank. Instead, it issues something called government bonds. A government bond is essentially a promise that the government will repay borrowed money at a specific time in the future, along with interest. Investors who buy these bonds are effectively lending money to the government in exchange for a predictable return. At first glance, this might seem like a simple financial arrangement, but government bonds play a much larger role in global finance than most people realize. Large financial institutions rely heavily on these bonds because they are considered one of the safest investments available. Banks purchase government bonds to store capital safely. Pension funds buy them to protect retirement savings. Insurance companies hold them as stable long-term assets. Even central banks themselves often buy government bonds as part of their monetary policy operations. Because governments are extremely unlikely to default compared to private borrowers, investors around the world view government bonds as reliable financial instruments. This constant demand for government bonds means governments rarely struggle to find lenders willing to finance their spending. As long as investors believe a government will eventually repay its obligations, demand for these bonds remains strong. This creates a situation where governments can continue borrowing money year after year without immediately triggering a financial crisis. In fact, in many cases, governments can borrow money at lower interest rates than almost anyone else in the economy. This unique position allows them to sustain large levels of debt while maintaining investor confidence. But the existence of this system also means something surprising. The global financial system actually requires a steady supply of government debt to operate effectively. Without government bonds, many financial institutions would struggle to manage risk and store capital safely. Banks often use government bonds as collateral when borrowing money from other banks. Investment funds rely on them to balance their portfolios. Central banks buy and sell government bonds in order to influence interest rates and control economic conditions. In other words, government debt has become deeply embedded in the structure of modern finance. This means that national debt is not simply the result of government decisions alone. It is also supported by the demand of investors and financial institutions that depend on these assets. Once the system became established, government borrowing began to evolve into something more permanent. Instead of eliminating debt entirely, governments began rolling it forward over time. When older bonds reach their repayment date, governments often issue new bonds to replace them, effectively refinancing the debt rather than eliminating it. As long as investors continue purchasing the new bonds, this cycle can continue indefinitely. This process is similar to how many large corporations manage their financial obligations. Companies frequently refinance debt rather than paying it all off at once, allowing them to spread payments across long periods while continuing to invest in growth. Governments operate under a similar principle, except on a much larger scale. Another key factor that allows this system to function is economic growth. As economies expand, the total amount of goods and services produced each year increases. This growth generates additional income, employment, and tax revenue for governments. Economists therefore measure national debt not only in absolute terms, but also relative to the size of the economy. This measurement is commonly known as the debt-to-GDP ratio. GDP represents the total economic output of a country in 1 year. If the economy grows faster than the national debt, the relative burden of that debt becomes smaller over time. For example, imagine a country that owes $1 trillion while its economy produces $2 trillion each year. If the economy grows to $3 trillion while the debt remains the same, the country becomes more capable of handling its obligations. Growth effectively makes the debt easier to manage. This is one of the reasons governments often prioritize policies that stimulate economic expansion. Infrastructure investments, technological innovation, trade agreements, and education programs can all contribute to long-term growth. When growth remains strong, governments can maintain higher levels of debt without facing immediate financial stress. However, the situation becomes more complicated when economic growth slows down. If debt grows faster than the economy itself, the burden becomes heavier over time. Rising interest payments can begin consuming larger portions of government budgets, limiting the ability to spend on other priorities. This is why economists closely monitor debt-to-GDP ratios rather than focusing solely on total debt numbers. A country with a large economy can sustain more debt than a smaller economy because it has more resources available to repay lenders. Interest rates also play a crucial role in determining how manageable national debt becomes. When governments borrow money through bonds, they agree to pay interest to investors. The interest rate determines how expensive the borrowing becomes over time. Lower interest rates make borrowing cheaper and easier to sustain, while higher interest rates increase the cost of maintaining debt. Central banks influence these interest rates as part of their responsibility to maintain economic stability. During economic slowdowns or recessions, central banks often lower interest rates to encourage borrowing and investment. Lower rates stimulate economic activity by making loans cheaper for businesses and consumers, but lower interest rates also make it easier for governments to borrow larger amounts of money. When borrowing becomes inexpensive, governments may increase spending to support economic growth or stabilize financial markets. Over time, this can contribute to rising debt levels. Yet another factor quietly influencing national debt is inflation. Inflation refers to the gradual increase in prices across an economy over time. As prices rise, the purchasing power of money decreases. While inflation can create challenges for consumers, it also has an interesting effect on government debt. Because governments repay debt in future currency, Inflation can reduce the real value of that debt over time. In simple terms, the money repaid years later may be worth slightly less than the money originally borrowed. This means inflation can make large debt burdens easier to manage in the long run. For this reason, economists often view moderate inflation as a normal part of modern economic systems. It helps economies adjust to growth, wages, and changing market conditions, while gradually reducing the real weight of existing debt. Taken together, these factors reveal something important about national debt. Debt does not exist simply because governments cannot control spending. It exists because modern economies are built around borrowing, investment, and financial markets that rely on government bonds as stable assets. Economic growth, interest rates, investor confidence, and inflation all interact to make national debt manageable over long periods of time. Understanding these forces helps explain why countries rarely eliminate their debt completely, and why borrowing continues to remain a central part of economic policy in the modern world. At this point, something important becomes clear, and it changes the way we usually think about national debt. Most people assume that governments are constantly trying to eliminate debt entirely, but in reality, the goal of modern economic policy is often very different. Instead of removing debt completely, governments focus on keeping it manageable and sustainable over time. As long as investors continue believing that a country can repay its obligations, borrowing can continue without triggering a financial crisis. This confidence plays a powerful role in maintaining the stability of global financial markets. When investors trust a government, they continue purchasing its bonds, which allows the government to refinance older debt and maintain access to funding. This process is sometimes described as rolling over debt, where new borrowing replaces older obligations rather than eliminating them entirely. While this might sound risky at first, the system works as long as economic growth, tax revenue, and investor confidence remain strong enough to support the debt. In fact, some economists argue that government debt actually serves an important purpose within the global financial system. Government bonds provide safe assets that banks, pension funds, and financial institutions rely on to manage risk and store capital securely. Without these bonds, many financial markets would struggle to operate efficiently. Banks often use government bonds as collateral in financial transactions. Investment funds rely on them to balance portfolios, and central banks use them to influence interest rates and manage monetary policy. Because of these roles, government debt has become deeply integrated into the structure of modern financial systems. This means national debt is not simply a side effect of economic policy, but a central component of how modern economies function. At the same time, the existence of debt does not mean there are no limits. If borrowing grows too quickly relative to economic output, countries can face serious financial challenges. High debt levels can lead to rising interest payments, reduced government spending flexibility, and concerns about long-term stability. History provides several examples where countries struggled to manage excessive debt during periods of slow economic growth or financial crisis. However, these situations usually occur when economic fundamentals weaken, rather than simply because debt exists. This distinction is important because it highlights the role of growth, productivity, and stable institutions in maintaining financial stability. As long as economies continue expanding and governments maintain investor confidence, large debt levels can remain manageable for long periods of time. Another reason debt continues to exist is the role it plays in responding to economic shocks. When financial crises, recessions, or global disruptions occur, governments often increase spending in order to stabilize the economy. Borrowing allows them to provide support for businesses, workers, and financial systems during difficult periods. Without the ability to borrow money quickly, governments would struggle to respond effectively to large economic disruptions. This flexibility is one of the reasons modern economies rely on debt as a policy tool. Instead of waiting years to accumulate tax revenue during a crisis, governments can borrow funds immediately and address the problem before it spreads further through the economy. While this approach increases debt in the short term, it can help prevent deeper economic damage that would be far more expensive in the long run. Over time, these cycles of borrowing during crises and managing debt during periods of growth have become a normal part of economic management. Debt rises during difficult periods and stabilizes or grows more slowly during stronger economic conditions. Understanding this pattern reveals why national debt rarely disappears entirely. Modern economies are not designed to eliminate debt completely, but to manage it within sustainable limits while supporting long-term growth. This realization changes the way we interpret the large debt numbers that often appear in news headlines. When people hear that a country owes trillions of dollars, it may sound like an immediate financial disaster, but those numbers only tell part of the story. What matters more is whether the economy continues growing, whether investors maintain confidence, and whether the government can continue managing its obligations responsibly. In many cases, national debt functions less like a household loan that must be fully repaid and more like a permanent financial structure that evolves over time. Governments borrow, invest, refinance, and manage debt as part of maintaining economic stability and supporting development. This does not mean debt can grow forever without consequences, but it does mean that eliminating it entirely is rarely the primary objective of economic policy. Instead, the focus remains on balancing growth, stability, and financial confidence. Once this perspective becomes clear, the idea that countries are always in debt begins to make much more sense. National debt is not simply a sign of economic weakness or government failure. It is part of the structure of modern economies and financial markets. Governments borrow in order to invest. Financial institutions rely on government bonds as stable assets. And economic growth helps maintain the balance between borrowing and repayment. When viewed from this perspective, debt becomes less mysterious and more understandable as one of the mechanisms that keeps the global economy moving. The next time headlines announce that national debt has reached a new record, it may not simply be a story about financial danger. It may also be a reflection of how modern economic systems operate, where borrowing, investment, and growth are constantly interacting with each other to shape the future of national economies.